Good morning friends, welcome to this comprehensive revision series of CA Final Advanced Financial Management. Today we are going to revise yet another important topic, that is portfolio management. Every attempt, 14 to 16 marks is getting tested from this chapter, very technical in nature as well as lengthy, and we will try to upload part by part, and once the final part is uploaded, the PDF for this chapter will be available freely in our website, you can access. See, all these are learning objectives. We will have a brief introduction to the chapter. We will have a brief introduction to the chapter, and then we will move on to specific topics like Markowitz portfolio theory, CAPM, arbitrage pricing, all the noble winning theories we will try to revise quickly. See, what is this chapter all about? I told you, value of any asset as per a discounted cash flow method is nothing but present value of future cash flows discounted at required rate of return of the investors. We saw this in the bond valuation chapter, we also saw this in equity valuation chapter, and we also saw in option valuation. Option valuation model, in the introduction part I also discussed the present value of the future cash flow, how to arrive at all these things. We discussed already valuation, we discussed in these chapters. Now what is this chapter all about? This chapter is all about discount rate discovery, which means what is the required rate. You told we should consider the required rate and discount these cash flows. What is the rate which should be taken for discounting these cash flows to arrive at the value of any asset? This is what we are going to predominantly discuss. Are you understanding? So two things mainly you should think. One is that, see, how to measure the risk. Then for a given level of risk, how much additional return I should ask, from this security. Are you understanding how much the investors should expect from this security? This is what is all about, correct? So we have two things to find out. One is that how to measure the risk. One is how to measure the risk. Second is, for a given level of risk, how much return we should ask. These two things we need to find out. See, the chapter will divide it into various aspects. One is the risk return. First we will try to find out what is risk and return based on the mean variance analysis. That Markowitz portfolio theory, the core of Markowitz portfolio theory. In fact, Markowitz portfolio theory itself, inside the theory itself, they try to find out the risk. They try to measure the risk using mean variance analysis. This is what they use the tool. This is what they use for analyzing the portfolio. So Markowitz portfolio theory we will discuss, then we will discuss capital allocation line, capital market line, capital asset pricing theory, CAPM, sharp single index model, and arbitrage pricing theory is the agenda for this chapter. Shall we start with risk return? See, while discussing the risk and return, you need to understand, see, what we are going to do now. First we will try to find out risk and return for the individual securities in the portfolio, which means you forget about portfolio. What do you mean by portfolio? Portfolio is nothing but group of assets, correct? So which means a portfolio will have equity shares, X limited, Y limited, any company's equity shares, or bonds of any company, debentures, bonds, gold, real estate, anything. Portfolio simply means group of assets. Now, first step, what we will try to find out is that risk and return we will try to find out for individual security. How to compute risk and return we will try to find out for individual security. Then we will try to find out risk and return for portfolio of securities. Portfolio of securities. Are you understanding? Then thereafter we will discuss various concepts like correlation, covariance, all these terminologies we will try to understand. Statistical terms only, simple, straightforward. I will assume you don't know anything and start revising. Are you understanding? So risk and return of individual security. How to find out risk and return of individual security? See, first I will come to the risk part later. First we will try to analyze how to find return for the security. Very simple. While computing return for the security, you need to understand that, see, return always is expressed in percentage terms in the market, or standardized term. What is a standardized term? In the percentage terms it is expressed, which means, see, for comparability, securities return is always expressed in annualized percentage terms, which means, see here what happens. Simple return of security, which means if you are analyzing past prices, price at the year end P1 minus price at the year beginning, this will be nothing but the capital appreciation from the equity share, which means today you invested in equity shares of Reliance Limited at 1,000 rupees. Tomorrow it became 2,000. 100% return, 100% capital appreciation. This is the P1 minus P0, shows us the capital gains portion. Plus you have dividend. This is the income arising from equity shares divided by P0. This will give you return. This will give you return of the security, which means return of the security is nothing but P1 minus P0 plus the dividend for that particular year, which means first year return if you are computing, that first year dividend you will consider and divided the whole divided by P0, you will get the return in percentage terms. Very simple. See here what happens. Year 0 price is 100. Price today of a share is 100 rupees. Next year this price became 105, and the second year, which means the first year, the company paid a dividend of 2 rupees, which means 105 is P1 minus 100. Up 5 rupees is the capital gains portion plus 2 is the dividend divided by 100. You will get annualized return for this year. Okay, see here, opening price, here I have given an illustration, quickly you can go through. Opening price is 100, closing price is 105. So the difference between opening and closing will be the capital gains portion from the equity shares. Okay, 5 rupees capital gains, then dividend 2 rupees paid, so 5 plus 2 7 divided by 100. 100 is price at the year beginning, year 0, what was the price? 100, so 7% is the return. Next is second year return. When you are computing, okay, you see what happens. Okay, P2, it will become see here, 105 is there, closing price is 108, which means second year when you compute, it will become P2 minus P1 plus the second year which is dividend. Okay, this is D2, then divided by P1. Like this you need to consider. Are you understanding? Which means what happens, you see, closing price is 108, 108 minus 105. Okay, even though the question will arise, now see, you have not sold the security. Now the doubt is, sir, 100 rupees I bought the security, purchase price should be considered, why 105 is considered here as P1, why it is considered? Now you see, every year you will assume that mark to market procedure, like mark to market procedure, you will assume that every year you have sold the security and bought the security again. Are you understanding? Even though this is not realized capital gain, this may not be realized capital gain. Okay, even if you are holding the security, which means for respective second year alone, if you are computing the return, you should not compute the, you should not include the initial purchase price. Okay, are you understanding what I am trying to say? So 100 should not be considered here. While computing the second year return, it should be 108 minus 105. Okay, divided by 105. This like P0, just like P0, it is P1, which means you are computing the second year return plus dividend. You will get the second year return as 3.81%. Are you understanding? Next, third year return, how will you compute? 108, this third, see, 90 minus 108, which means from second year the price was 108, and third year in the price is 90, which means price fell, capital gain or loss, lost, which means 90 rupee minus 108. How much is that? 18 capital loss. Okay, any dividend? Nothing. Yes, dividend is, yes, third year dividend is not there. Here, second year dividend 1 rupee is there. Okay, 3.81%. Now, third year, when it comes to third year, 18 capital loss, no dividend. Hence, 18 divided by opening price 108 will be the return, 16.67% return. Are you all understanding? Each and every year, how to compute the return? Okay, from the market data is what we learned. Are you understanding this? Annual return, simple annual return. 3 years return you have, right? Now, when you are trying to predict the future, when you are trying to buy the security, what you will do, you will try to expect something, you will expect something in the future, which means assume 3 years gone. Now you are standing at the end of third year, you are trying to buy the security, and you are trying to analyze how much return it will give in the future. You tell me, children, okay, whether you will expect, this is the 3 years, past 3 years return I have analyzed. First year it gives me 7%, second year it gives me, okay, 3.81%, third year it gives me minus 16.67%. Can you expect 7% return for the fourth year? Or to put it simply, can you expect even minus 16.67%? Need not be. Okay, are you understanding what I am trying to say? You should not expect extremes, which means this has given a highest return of 7% in the first year, lowest return of minus 16.67% in the previous year. Whether you can expect extremes, you should never expect extremes, you should only expect average, which means from this security, if I buy the security, for the past 3 years I have analyzed the data. Okay, I understood that year 1 it gave 7%, 3.81 in the year 2, then year 3 is minus 16.67. Can I expect, okay, minus 16.67 or 7% in the fourth year? No, you should never expect extremes, you should only expect average. So, till now we discussed how to compute the return for respective years. Now we will try to analyze how to expect the future, how much return I can expect from this security in the future. This is called as expected return. What you will expect? You can only expect a mean only you can expect, average only you can expect. You can neither expect 7% at the higher end, or neither you can expect minus 16.67% at the lower end. You should expect only average. Now you need to compute mean return. So mean return you need to compute. This is what is called as expected return. Okay, mean return is called as expected return. Now there are two ways to compute this expected return. One, using, see, this is why I told you here, we need to answer 2 questions to understand a security. Okay, yearly data you have, using the past data, what is the return we can expect this security? So what is the return, expected return you need to take, and how certain is that expected return? This return is nothing but mean return, x bar, I call it as x bar, mean average return only you can expect. Thereafter, okay, how certain is that expected? Now, whether this is certain, very simple. Okay, 7 plus 3.81 plus minus 16.67 divided by 3, if I do, I get some number like 1.95% or something, correct? This is the average return for the past 3 years. If I do take the simple average, can you, expect every year 1.95% from there? No, it cannot be. So which means there will be deviations. How certain is that expectation? Which means this portion covers the return. What is the mean return, expected return? Then how much is the deviation from the mean return? I think of average return, and I also try to predict what is the risk. Are you understanding? For example, if a person is going for AFM exam, okay, you tell how much marks you expect from this exam. He tells 60%. You tell me how much could be the deviation. He tells plus or minus 10%, 10 marks, which means 60 plus 7. It can go up to 70, or lower end it can also go up to go down to 50 marks. Are you listening? So this is the that catches the risk perspective. So this is the return and this is the risk. The answer to these questions can be understanding by analyzing the securities using 2 different data. One is past data and other is future data, which means very understanding a security by analyzing its past performance. I call it as exposed data, and predicting the future performance using probability based scenario analysis. Okay, so we have without probability, when you analyze the past data of this security and try to predict the future, this is one way. Or you try to fix a assign a probability, you try to predict the future. The next 2 parts will be dealing with exposed and ex ante appraisal of the security. Now I need to compute mean return and deviation from the mean. For this, 2 types of data can be available. One is exposed data and another is ex ante data. Are you understanding what I am trying to say? That is what we are going to discuss here. Risk and return of the security when exposed data is given without probability. Okay, when question is giving you probability, now it is ex ante data. When it is not giving probability, past 5 years, 10 years, 3 years given, it is without probability. Are you understanding? Without probability. Now see. Return, how to compute return? See, if we try to analyze past returns of data of security, find the expected return, it is called as exposed return. Of course, expected return is nothing but average return or a mean return, as we should not expect extremes. For example, if you are analyzing past 5 years data, then the mean return will be the total return of the past 5 years added and divided by number of years. Simple mean return, simple average you will consider. Okay, summation of all the returns, okay, you will consider divided by n. N mean number of years. This will give you x bar. I call it as x bar, nothing but mean. Okay, mean is represented as x bar. Okay, are you understanding? This is it. Now, see, now you told that you should not assume extremes, you should not consider extremes, right? Now, mean return is some number. Mean return, assume in this previous question, okay, take your calculator, 7 plus 3.81. Okay, see, 7 plus 3.81 minus 16.67 divided by 3, 1.95%. In this question, 1.95% is the x bar, simple mean return, correct? Will you expect every year 1.95% from this security? Minus 1.95% from this security? No. Which means this is certain or uncertain? Uncertain. It can deviate from the mean, which means mean is, I agree, the mean is 1.95%. But the real return can deviate from left and right. Okay, can deviate more or less from 1.9 minus 1.9%. Are you understanding? Now, this is the deviation. Okay, is nothing but the risk of the security. How much, if it is certain that it gives 7% return every year, then there is no deviation. It will be equal to risk-free security, just like your Government of India bond, which offers 7% return every year, 7% or some number every year. Correct? There is no deviation. Okay, but here there will be deviation. The deviation represents the risk. How to compute the risk? Very simple. The standard deviation, it is measured as standard deviation sigma x is nothing but, okay, square root of summation of x minus x bar the whole square divided by n. Are you understanding? This is the formula for risk, for standard deviation. Risk is measured through standard deviation. What is the formula? Square root of summation x minus x bar the whole square divided by n, provided we are analyzing exposed data. when we are analyzing past data, okay, number of years given, you should use this formula. Are you all understanding what I'm trying to say? Now let us simply understand this using, okay, one question. So we understood three things here. One is that every year annual return how to compute, basic return how we should compute, and you have return for 5 years. Are you understanding this? That you should understand, you should segregate what we have learned. See here, first thing, this is there na, this question we did na, first example we did na. What it is all about? Finding yearly returns, finding yearly return, first year, second year, third year, like this you found out return, correct? Are you understanding what I'm trying to say? Next step, how to find the mean return. Why? Because when you are computing return, expected return of the security, it is mean return. When you are finding mean return, you should consider all these respective years return, then total it divided by n, simple average you will consider for computing mean return. Are you understanding this? Next, when you are computing risk of this individual security, risk how to find? Very simple, standard deviation is denoted by standard deviation is equal to, okay, square root of summation of x minus x bar the whole square divided by n. Here also x minus x bar the whole square which you are computing. See here, x minus x bar, now what mean? X bar means mean, okay, then x minus x bar the whole square divided by n. Are you all understanding? See, this question we will take and understand. Risk and return of individual security without probability. First question without probability I will try to solve, then with probability also we will try to solve. See, the following is the return of two securities for the past 5 years. Calculate for each the expected return as well as risk. So risk and return, this is what we are going to compute. Agreed? Now, past 5 years data given ex ante ex post question, right? So security X, security 1, two securities are given. Each year these returns have been computed. This you need to understand, this is nothing but 6.6 rupees a dollar a percentage, 5.6 percentage, 9%, minus 9 percentage, 12.6, like that, all are in percentage terms. You tell me children, how this year 1 6.6 would have computed? P1 minus P0 divided by P0 plus dividend. Okay, this is how yearly return would have been computed for all these years. Are you understanding? Thereafter, they have summarized all these data for past 5 years and they have asked us to solve return, average return, expected return, which means mean return. We need to compute mean. Okay, now how to find mean of security X? Very simple. What we are considering, year 1, 2, 3, 4, 5, X and X minus X bar. First step, X you will write and total you will find out the X. Upper summation of this X is how much? 29.8, correct? This 29.8 divided by 5, 5.96 is the X bar. So X bar, what is the X bar? Okay, 5.96. This 5.96 you should consider in the table, 4 columns should be considered. Here, okay, return of security X, then X minus X bar, then square it up, X minus X bar the whole square. Are you understanding? So X minus X for respective year, first year 6.6 X minus 5.96.64. Are you all understanding what they have done? Next, 5.6 minus 5.96 minus 3.6, X minus mean. Okay, you square it. This is X minus X bar. Now you should square it up. You should square it up. See what happens. Why we need to square and find variance and then standard deviations? And what is the use of this? Now, very simple. See, this term, this term is known as variance. The 333.072 is called as, also called as variance. So this term, see here, very simple. See here the 333.072 divided by 5. Okay, this term is called as variance. This is called as variance. Now, why we need to square root? Very simple. If you calculate the deviation, the variance is the total deviation. But we need to find out, for the simplicity, if you see here, there are minus, negative signs of the, if you add up all these, okay, the X minus X bar column, if you add, it will be simply 0. If you notice, if you add up all this, you will get 0. Are you all understanding? There will be no meaningful, okay, measurement. Therefore, what we need to do is that, okay, statistical measure, you need to square it up. You need to square it up individually. You square it up, and then you get the total of this, okay, divided by n, and again square root. You take square root, get the standard deviation. You will get the standard deviation. As the name suggests, it's a standardized measure. What is the difference between variance and standard deviation? Standard deviation is a standardized measure, even though variance try to find out all the variations, correct? But it should be for comparability, for simplicity, you need to, okay, have a standardized measure now. For that, okay, these minus signs are all should be removed. Hence, you square it up and then you will take the square root. Are you understanding? So, X minus X bar, you square it up, 0.4096, like this, everything you will square. and if you divide it by n and square root, you will get the standard deviation. How much is the standard deviation? See, summation of x minus x bar the whole square. This is nothing but 333.072, which we found out, okay, in the tabular form. Divided by n, divided by 5 if you do, you will get 8.16. See, always standard deviation also in percentage terms. Okay, are you understanding? Standard deviation also in percentage, because return is also in percentage terms. Standard deviation is also in percentage terms, 8.16. Security y, same way you can compute for all these 5 years. Okay, y minus y bar the whole square. These are all the different columns. So what is the formula for standard deviation? Standard deviation is nothing but square root of summation of, okay, y minus y bar the whole square divided by n. This is y minus y bar the whole square, and 896.9 divided by 5. Okay, so square root it, you will get 13.39 as a standard deviation. To put it simply, here we can say that, okay, for the security S, I can write like this: return and risk. Okay, for security X, what is the mean return? You tell me, children, what is the mean return? 5.96. 5.96 is the X bar for security X. For security Y, what is the mean return, expected return? 9.1. Are you all understanding? 9.1. Okay, 9.1. And risk for this security, you tell me, what is the risk of this security? Security X is 8.16. 8.16%. Here also, what is the risk? 13.39. Are you all understanding? 13.39. Okay, see, here we have computed return for both these securities as well as risk for both these securities. Risk and return. So till now what we learned? Computing risk and return for individual securities where probabilities are not given, which means past data are given, and we need to analyze the mean. We need to analyze the mean return as well as the deviation from the mean. So this is how you compute individual securities risk and return when probability is not given. Shall we move on to the probability? Yeah. See, next, risk and return of the security. Okay, ex ante data. By analyzing ex ante data, by using the ex ante data, means probability. When probability is given, how to compute it? Very simple. See here what happens. Now, the simple average, we computed simple average mean. Now we need to compute mean, weighted average mean we need to compute. How to compute weighted average mean? Very simple. See here, X is there, Y is there. This question, we can understand this through the question. The formula undergoes a small change. Okay, return is very simple. Return, earlier what you do? Total return, okay, you consider. Total return you consider, divided by n you did, and found out the average return, simple average. Here what you do now, every year there will be some probability will be assigned, correct? That probability, respective probability into return of the respective year you will consider, and the total, okay, you will get the weighted return, where probability is the weight and return of the individual security you should multiply and get the total. Are you understanding? Risk of the security using probability, okay, there also one change will be there. What was the formula earlier? Okay, you did divided by n, the n vanishes, P will represent that. So how to do? Very simple. Square root will be there, right? But instead of dividing it by n, what you should do? Okay, summation of P into x minus x bar the whole square. Are you all understanding? Which means x minus x bar the whole square, the tabular representation will be same. X minus x bar you will find out, but you will multiply, okay, that particular individual year's variance terms into probability for the respective year, and total you will get in the column not, okay, that you will square root it. Are you all understanding? That will be the variance, hence you will square it up. Are you all understanding? See this question, it will be very clear. The following is the forecast of return of two securities along with the probability for their occurrence. Calculate the expected return and risk of both these securities. Expected return and risk of both these securities. Probability given, return given, which means next year, which means I am my expectation is 10% or 20% or, okay, 25% or 20, no, my expectation is average. How much I can expect? See, very simple. I am expecting 10%. I think that there is a 5% chance the return to be 10%. Okay, I think there is a 20% chance for the return to become 20%. Like this, I assign probability for each of these returns, which means on an average, how much I am expecting is nothing but 10 into 0.5%, 20 into 20%, 20 into 50%. Like that, I will compute weighted average mean. Are you all understanding? See how we will compute. We are going to see. So again, we need to compute return as well as risk. Return as well as risk. How to compute return? Very simple. probability x, x minus x bar, probability into x minus x bar the whole square. See here, if you present this table, automatically x bar will also be computed. How you see? We are going to see. Very simple. Here I have given x bar computation. This is nothing but return computation. For risk computation, this will be useful. Hence, we will use the table. Are you understanding? See, what is the x bar? Okay, 0.05 into 10 plus 0.2 into 20, 20% into 20, like this. See, 0.5 into 10 plus 0.2 into 20 plus 0.5 into 20 plus 0.2 into 25. Like this, you will compute the total. Okay, it comes to 20.75. The 20.75 is x bar, mean return. Are you all understanding? Now, what is x minus x bar? X bar you computed using probability. Now substitute the number 20.75, that x bar will remain same, that you substitute. Okay, 10 minus 20.75 minus 10.75, 20 minus 20.75 minus 0.75. Like this you need to compute again. Now you need to square it up. Minus 10.75 into 10.75 minus 10.75 into probability. You square it up, multiply it with the respective probability. Okay, 0.05 na. So very simple. For the first two things I will compute. Minus 10.75 into is equal to, how much is that? 115.5625 into 5%, 5.7781. Are you all understanding? Like this you need to compute. So just to square it up and multiply it with probability, this column number 1. Are you all understanding? You will get the total. Okay, this is nothing but variance term, 10.6875 directly will become the variance. You need not even divide it by 5. The n only, okay, divided by 5, the n only became probability where ex ante data is given, where the future data, prediction based data is given. So standard deviation is nothing but, okay, square root of p into x minus x bar the whole square. The p into x minus, summation of p into x minus x bar the whole square. The summation of p into x minus x bar the whole square is nothing but 10.6875, which means square root of 10.6875, 3.27% is the risk for this security. Are you all understanding? Okay, this is how you will compute, okay, when probability is given. Next, again, security y. Please go through the same computation. I don't want to again and again discuss here also why every year return is given. Now, what you will do? Quickly tell me how you find x bar. 0.05 into 18 plus 0.25 into 12 plus 0.4 into 28. Like this, every year you will find out the mean return x bar. You will find out like this. Thereafter, you substitute the mean here, x bar, y bar. So y minus y bar comes to 24, 18 minus 24 minus 6, 12 minus 24 minus 12. Like this, you will find out, square it up, again multiply it with probability, total it, you will get 58. This 58 is nothing but variance divided by square root it, and you will get 7.62 as the standard deviation. So till now what we discussed, risk and return of the individual securities, where, okay, past data is given or where the probability is given. Under both the scenarios we have computed, we have learned how to compute risk and return of the security. Shall I move on? Okay, next topic, risk and return of the portfolio. Now comes the important topic. See, what happened till now is that we computed risk and return of individual securities. Now, if you combine these securities and form a portfolio is nothing but group of assets. Say, in the previous question, we saw individually how the risk and return of the security X is computed, Y is computed. Now, I am constructing a portfolio where I include a security X as well as security Y. Now, I need to compute portfolio return and risk. Portfolio return and risk. Say, first step, what is the return of this portfolio? Return of portfolio is very simple and straightforward. Return of portfolio is nothing but, okay, weighted average return of the individual securities inside the portfolio, which means, see, very simple, I construct a portfolio in my bag. I construct a portfolio which is having two security. I am having a bag which is having two security, two vegetables, two securities having. One is X, one is Y, correct? Now X, I am putting 50% of my money in security X, security X, 50% of my money in security Y. Are you all understanding? This security is giving me 20% return. This security is giving me, assume, 10% return, which means 50% of my money is generating a return of 20%. balance 50% of my money is generating a 10% return, which means this is giving 10% and this is giving on an average 5%. Up 10 plus 5%, 15% will be my on an average return from the portfolio. So very simple, return of the portfolio is nothing but weighted average return of the individual securities inside the portfolio. The weights will become the proportion of the securities which is invested. Are you all understanding? So which means the proportion of the money which you invest in individual security becomes the weight, and simple probability based computation you did na, same way this also we will find out weighted average return. So see here, when a person holds more than one security, he is said to be holding a portfolio of security. How an individual security has risk and return, the portfolio also has risk and return. Return of a portfolio is simply the weighted average return of the individual securities inside the portfolio, where the weights are the proportion of the investments in each security. Proportion of the money put in each of these securities will become the weight of the security. Are you all understanding? We have a question, we will do that, you will understand everything. Very simple. Okay, now comes the important discussion. Risk of the portfolio. See, this is not risk of the individual security, we are trying to find out risk of the portfolio. You tell me, what could be the, return of the security is nothing but weighted average return of the individual securities inside the portfolio. Can risk also be same? Risk of the portfolio is nothing but weighted average risk of the individual securities inside the portfolio. Okay, no. Risk, when you are computing portfolio risk, there are three factors which affects the portfolio return. See, very simple. What happens? Here, when it comes to return, I have only two factors affecting the return, which means the proportion which you invest, the amount of money you invest, I call it as proportion. How much money I invest in individual security will affect the portfolio return. Obviously, see, if you invest 99% of your money in Government of India bond and only 1% of your money, in Reliance Limited, which is giving 100% return, assume, for that year, whether you will realize anything big in your portfolio, nothing you will realize as such. Are you understanding? So proportion influence, the amount which you put in individual securities also influences the portfolio return. Thus we already know. And the return, actual return earned from the security will also influence. These are the two factors which influence the portfolio return as such. Are you understanding? So proportion and return generated by the individual securities will affect the portfolio return. But when it comes to risk, this is nothing but portfolio risk. Portfolio risk. I'm talking about portfolio risk. Now portfolio risk, you tell me, the proportion will again affect the risk of the portfolio, correct? It will affect 99% if you invest in risk-free asset, then your portfolio is substantially risk-free only, even though you just invest 1% of your money in Reliance Limited. Understood? So proportion will have influence for portfolio. Then return of the individual security is obviously the return of these securities. Security will influence the security X or security Y. Will obviously influence. Are you understanding? So this security X or security Y's risk will influence, which means return of we are computing risk of the security now. So the risk of security X, see here, I can write like this: the risk of X and the risk of Y will obviously have impact on the portfolio risk. But apart from that, there is very important feature, that is co-movement of these securities. When you see individually, if you have X in your portfolio or Y in your portfolio, it doesn't matter. But when you put both of them in one bag, when you are trying to invest in a portfolio consist of these securities, it will have a co-movement effect. This will have co-movement. Its co-movement of these security will also have the effect. Which means here I can say that the co-movement or correlation, I simply call it as R, correlation, which means portfolio risk is affected by three factors. One is the proportion of the securities inside the portfolio, risk of the individual securities inside the portfolio, as well as the correlation of these two securities or three securities. If you are constructing three securities, if you are constructing two securities portfolio, it depends. Correlation among these securities which are inside your portfolio will also have, correlation is nothing but co-movement. We are going to learn that. The co-movement of these securities will also have the impact on the portfolio risk. Are you understanding? See here, this is what we are going to learn here. See, risk of the portfolio. So portfolio risk formula, we need to find now. These three factors, using these three factors, we construct a formula, based on which is simple, nothing but A plus B the whole square formula is there now. Just the same formula only, little bit alteration is required using the correlation effect. We have to give correlation effect. See here, risk of the portfolio is not weighted average risk of the individual securities. Okay, it is calculated using the formula for portfolio standard deviation. What is that? See, square root of, okay, see, weight 1 square sigma x square, okay, this is plus, see, very simple, a plus b, the whole square formula is there now. You will replicate it, very simple. This is a square. Here a, you will consider weight as well as the risk of the portfolio, which means w1 sigma x. Okay, this is wx also you can say, because how much, if the proportion of the security x inside the portfolio, this is w1 means wx. So I can say wx sigma x square. Okay, you can also write wx sigma x the whole square, which is sigma x square, which is same, wx square into sigma x square. Are you all understanding? This is a square term. This is a square, like this you can remember, a square plus b square mean wy square sigma y square. Are you all understanding? This is b square term, a square plus b square plus 2ab na 2 into wx sigma x wy sigma y. Apart from that, just into correlation of x and y. Are you all understanding? This is correlation of x and y. This alone you will add, but all the remaining things are same. A square plus b square, just substitute. Correlation will be there. For that also I explain the logic, because a correlation will have the impact when you construct a portfolio. So apart from proportion and individual securities risk, correlation will also have the impact. So what is the formula? Please tell me. Square root of, okay, wx square sigma x square plus wy square sigma y square. The 1 and 2 is nothing but, okay, the proportion of x, that is only I call it as 1. Okay, w2 means ideally it is nothing but wy square. You can also say it is wy square, wx square. Okay, it need not be x or y now. That's why I put w1, w2. Which means what is the weightage of x? It is understood to be as w. Sometimes it may be security m and n. Okay, in that case it becomes wm or wm. Wn. Are you understanding? So square root of wx square sigma x square plus wy square sigma y square plus 2 into wx wy sigma x sigma y into correlation of x and y, correlation of x and y. From the above formula, we can understand that the portfolio risk is influenced by 3 factors. Portfolio risk is influenced by 3 factors. Risk of the individual securities will surely affect the risk of the portfolio. Are you understanding? I already explained that individual securities risk is relevant. Just like in portfolio return, individual securities return was relevant now. Same way portfolio risk, for portfolio risk also, individual securities risk will be relevant, and proportion of these securities is also relevant. Apart from that, the co-movement of the security will become most relevant. Are you understanding? So this is unique. Okay, with respect to return, you don't consider the co-movement at all. With respect to risk, you need to consider the co-movement. Why? Because risk arises from the deviation from the mean. Risk is nothing but the deviation. Okay, the deviation arises due to uncertainty. Now the point is, okay, see, when you construct a portfolio using 2 security, it may be sometimes what happens, the 2 security may, okay, go in opposite direction. X gives you a positive return, Y gives you a negative return. The co-movement also becomes important. That's why you need to capture the co-movement also, right? So represented by correlation coefficient Rxy, a correlation of x and y, represented by sigma x and sigma y, represented by w1 and w2 or wx and wy. Okay, this is all given. Now correlation, what do you mean by correlation is an important discussion now we are going to have. So risk of individual securities you already know, proportion of these securities no issues. Now correlation, you said you will have the impact in the portfolio risk now. See, now we need to understand what is this correlation. Question arises now. That's why I have given you correlation here. See, how to compute correlation at all, we will see in detail. First you need to understand what is correlation, then we will step by step we will try to solve numerical question also. I have put it for revision, everything we will discuss here itself. Listening up. See, first, what do you mean by correlation? I'll tell you. See, correlation is a standardized measure of covariance. We are going to learn covariance. See, there are 2 terms available, covariance and correlation. Correlation is actually derived from covariance. Now, what is covariance? Very simple. And what is so you need to basically understand the difference between covariance and correlation. Formula is there anyway. We will see first covariance. We will try to understand. From there you will get the correlation. So covariance formula divided by, if you standard deviation of individual securities, if you do, you will get the correlation. What is this correlation? What is this correlation? Covariance you need to understand. Covariance try to capture the direction in which these securities are moving. Are you all understanding? See, very simple. See, security X is there. security Y is there. To put it simply, I'll tell you, I use this example in my lectures. For example, see a family is there, say husband and wife are, right? Husband is saying, he is saying something to his wife, do this work, right? What wife says, na, she says, I will not do. Are you understanding? Now, every time when husband says, wife disobeys her, no. Mostly she obeys, but sometimes she doesn't agree. This is one example. Are you understanding? Which means there is correlation. There is correlation. Na? So the direction of the correlation, if you see, generally positive. Generally positive. Na? Mostly if he is saying something, she will agree. There is positive correlation, but sometimes there is negative correlation. This is fine. So the covariance captures the direction of the security, which means this is giving negative return, this is giving positive return for particular year. Which means, okay, how they are, the direction will be captured, how they are moving, these two securities, how they are moving in tandem, security X and security Y, how they are moving with regards to each other will be captured by covariance. Correct. The covariance is only co-movement, but in case of covariance, the strength is not captured. The strength is not captured. Correlation, okay, is a standardized measure of covariance only. It's a standardized measure. -1 to +1 will be the data. Are you all understanding? The correlation will capture the direction as well as the strength of the co-movement. For example, in case of security, if we use, okay, X, Y security is there, okay, security X is going up, security Y is going up. Mostly, okay, most of the time it is moving upwards. Now it also follows. Security X moves up, security Y. Security X goes down, security Y goes down. Security X goes down, again security Y goes down. But sometimes what happens, security X goes up, security Y goes down. Like this, there are some observations. Are you all understanding? But this is strong enough, na? So which means the strength of the co-movement is captured by the correlation. Strength of the moment is captured. So to put it simply, I can write it here. Covariance, okay, it captures only the direction of this security. The direction of the movement is captured, and correlation, okay, it captures two things. One is direction, okay, another is the strength of the co-movement. Strength of this co-movement. Both of these things are captured by correlation. Are you all understanding what I am trying to say? Now, this is a standardized measure for comparability. It is used from -1 to +1. -1 to +1. Which means, see here, I have put it here, correlation is a statistical measure that indicates the direction and strength of the co-movement between two variables. See, when I discuss the strength, I will discuss, when I discuss covariance, I will discuss, okay, how it is different. Are you understanding? At that time, this will be very useful to understand. See here, when R is minus, see, I will tell you one more thing. So correlation we are discussing, we are not discussing co-movement here, we are discussing correlation, because standard deviation of the portfolio in the formula, it is R, which is, representation of correlation. Correlation only we are discussing. Covariance, how to find out? We will, discuss this next step. First we will find out how to find out the correlation. We will try to analyze how to find out the correlation. See, correlation, the number will be +1, -1 to +1, -1 to +1, which means, see, I have 5 different possibilities. It could be -1, it could be +1. These are extremes. This is perfect positive, this is perfect positive, this is perfect negative. Okay, this is perfect negative correlation, this is perfect positive correlation. This, see, -1, then there is, see here, this is one branch, then there is -1 to 0. -1 to 0, then there is exact 0, then there is 0 to +1, okay, then there is exactly +1. Are you all understanding all these options? 5 different possibilities there. This is correlation. Okay, 5 different possibilities. Now when it comes to -1, when the correlation is exactly -1, it is perfect negative correlation. When the correlation is exactly +1, it is called as perfect positive correlation. And when correlation is in between these two, it is, okay, -1 to 0. When it is 0, it is no correlation. No correlation. Are you all understanding? -1 to 0, it is negative correlation but not perfect negative correlation. 0 to +1, positive correlation but not, okay, perfect positive correlation. Are you all understanding? Negative but not perfect negative. So these are all 5 different possibilities. So why this is important to understand? What is the use of it? I will tell you. See, there is there will be few theories, okay, diversification based theories, where they try to analyze that the portfolio risk will be reducing if you diversify your securities inside the portfolio. The more and more, very simple, one portfolio, if you have the portfolio consists of 4 security A, B, C, D. A, B, C, D. Assume you have only one security A. The portfolio will consist of A's risk. Na? If you add B to it, the portfolio risk will be even further diluted. It will be reduced because, okay, some may perform, some security may have higher risk, some security may have very lower risk. Are you understanding? Due to low risk security inside the portfolio, the overall risk of the portfolio risk reduction will happen. Agreed? So diversification reduces risk. Don't keep all eggs in one basket, you have saying now. Same way, diversification reduces risk. The more and more securities I add to my portfolio, okay, the portfolio is well diversified now, the risk reduces. To put it simply, I'll give you a classic example. Assume, okay, there is shares of airline based company, say Indigo Airlines company. Okay, there is the share X Limited, Indigo Limited. Assume the airlines based company shares are there. Then you invested in that security, and then you invest, say, FMCG oriented company, say Britannia Industries, okay, FMCG company, you invested. Now you tell me what happened during the recession period. During the recession period, when economic activity slow down, job data is not perfect, okay, everything goes down now. So travel, people, avoid traveling. Unnecessary people will avoid, people will not travel. In that case, the revenue of the airline company will go down now. Correct? Now, the point is, due to this recession, this will have impact, correct? But if you notice, the biscuits, some people will stop eating biscuits. No, no. So, the revenue of this company will generally not get affected. Are you understanding? Tea, coffee, business, biscuits, some daily activity which you are doing, okay, these companies' revenue will never get affected due to the overall recession in the market or some macroeconomic factors are coming. Okay, some geopolitical issues or macroeconomic factors, this will not get generally affected. Now the point is, if you have a security only Indigo Airlines shares in your portfolio, you tell me whether it is risky? Yes, of course it is risky. That's why you can also diversify in some other sector, FMCG sector. This is airlines based company. Now I go to FMCG sector and invest in one company. So this will reduce, yes, this is a very low risk company, and hence my overall risk of the portfolio is getting reduced. Overall portfolio risk is getting reduced. This is why called generally diversification reduces the risk. More and more security you inject into the portfolio, the overall risk of the portfolio will get reduced. Correct. Now the issue is that, see what happens. If my portfolio is perfect negative, if my portfolio is perfectly negative, what is the interpretation? I will tell you. See, the X perfectly negative means X goes up, Y also goes up. X goes down, Y also goes down, and the strength is also same, which means X goes down, goes up by this much amount. Okay, Y also goes by sorry, goes down by this much percentage, like this. Okay, the strength is also same, and the direction also is opposite direction, equal strength, perfect negative, and the portfolio risk can also be reduced to 0. This I will explain. Are you understanding? Okay, when the correlation is perfect negative, this is the example of this is the example when the correlation is perfect negative, which means you can select two securities which is having exactly -1 as co-moment and their strength. So this is one possibility, correct? Now -1 to 0, which means, okay, mostly they don't agree with each other, which means they don't move in tandem. X goes up, Y goes down. X comes down, Y goes up. Generally, they don't move in the same direction or strength. But the point is, okay, sometimes what they do, sometimes, okay, they move in the same direction. X goes up, Y also goes up. X goes down, Y also goes down. Are you listening? Which means there is correlation. Okay, negative correlation, but not perfect negative. There is negative, mostly negative correlation, but not perfect negative correlation. Then there is correlation, zero correlation. We cannot say we cannot establish any relationship. We cannot establish any relationship between these two securities movement, which means X sometimes goes up, Y sometimes goes up, sometimes they going together, sometimes they don't go together. Are you understanding? There is no relationship we can, viably establish. This is when we call it as zero correlation. There is no correlation at all, right? And next, positive but not perfect positive, there is possibility. Positive but not perfect positive. See, why I am explaining all this, you will understand in a minute. Please give me 2 minutes time, then you help understanding. Why this is important, na? People get confused with the positive, negative and all this. Okay, I'll conclude. When I conclude, everything will be crystal clear. Shall I? See, when the correlation is 0 to 1, which means there is positive correlation, mostly they move in tandem. Okay, if X goes up, Y also goes up. So sometimes they go in opposite direction, which is negative correlation, which is positive but not perfect positive correlation. Last one is perfect positive correlation. X also goes up, Y also goes up. This is called as, okay, X also goes down, Y also goes down. This is perfect positive correlation. See, one thing you need to understand, positive na, you don't think goes up na, goes up. No, X goes up, Y also goes up, X goes down, Y also goes down, which means it follows that in the same direction. Direction is captured. Are you all understanding? Direction and strength, the two things are important. Now, most important discussion, diversification will reduce risk. Yes, till you have perfect positive correlation. Till the +1, till the correlation is perfect 1 or perfect positive, till that time, or I can say 0.99 assume, till that moment, okay, diversification will reduce risk. Diversification can reduce risk. Are you all understanding? Okay, don't think if the correlation is 0.5 plus 0.5, this is positive. Only when negative correlation, I can reduce the risk. X goes up, Y comes down. So both are opposite effect, both are having opposite effect. Then the risk will reduce. Don't think negative correlation only can reduce risk. No. Positive correlation will also reduce the risk. Till +1, you can reduce the risk. You can reduce the risk. This simply keep in mind, profound discussion. Okay, why I am discussing all this? Okay, mostly what I discuss in regular batch, I am discussing here for this clarity, because when we compute the optimum portfolio as per the Markowitz portfolio theory or zero variance portfolio or minimum variance portfolio, at that time, okay, this concept should be thorough in your mind. Are you listening? So, which means till the time my correlation of these securities inside the portfolio is +1, exactly +1, till that moment I can reduce, keep on adding and reduce the risk of the portfolio. This you understood? Now I will give you a classic example, okay, to understand all these 5 scenarios. All these 5 scenarios. To put it simply, see, you have a assume this is a cart. This is a cart. Okay, this is assume a horse cart. We use horse cart is there. What do you do? Classic here there will be horse okay, this horse will be pulling this cart, right? But what you do instead, this side also you, okay, tie up another horse to this cart. Are you all understanding? There are 2 horses, okay, tied on the opposite side. Tied on the opposite side. Now, opposite side if I tie up, this is negative correlation. This is negative correlation. Agree? Now, correlation also captures the direction as well as strength. To illustrate that, I am trying to show you this example. Are you all understanding? Now, how the correlation captures the strength of the co-moment, I will tell you. You tie up this opposite side, 2 horses, opposite side, negative correlation. Agree. If these 2 horses are of equal strength, both these horses are pulling at the same rate, say, assume 50 km/h, some speed here. Okay, the same speed, this also is pulling. Exactly same speed, both the side, they are pulling each other, which pulling the cart. The cart will never move. Are you all understanding? Which means the movement of the cart, I can call it as risk. The movement of the cart, I can call it as risk, which means the risk will reduce. Yes, it can be reduced, even brought to 0, which means if you put a equal strength horse in both the side, okay, if the correlation is perfect negative, if a correlation is perfect negative of 2 securities, if you construct a portfolio using these 2 securities inside the portfolio, you can even reduce the portfolio risk to 0. This is called as zero risk portfolio. What is that? How it is computed, formula, derivation, everything I will discuss brief in few minutes. Just observe what happens when there is perfect negative. Horse, the cart will move, it will not move. Are you understanding? Upon no risk at all, zero risk portfolio is possible. Yes. Now come to the situation where the why I am discussing this. till 0.99 I told you na risk can be reduced. That is why I am discussing. Say -1 to 0, can you reduce the risk? Okay, can you reduce the risk if the risk is -1 to 0? Assume the same example, opposite direction minus correlation is negative, but not perfectly negative, which means this cart is, the horse is, okay, strong horse. This horse is a strong horse. This is a weak horse. Assume little bit weak horse, 40 km/h only it is pulling this side, which means you tell me what happens. This is strong horse na. Upper the cart will slowly move towards this direction, slowly moves towards the direction of the strong horse, which means, okay, the risk will be reduced, but cannot be brought down to 0. The risk cannot be, okay, totally brought down to 0. This is -1. Agreed? Now the question next is, no correlation, not at all discussing. No correlation is not there. Next, okay, 0 correlation, not at all discussing. 0 to +1. 0 to +1. Okay, yes, 0 to +1. What happens? This is the main discussion. When the correlation is positive, but not perfectly positive, 0 to +1, I can say the correlation is 0.75. You tell me the risk will reduce. Our portfolio risk can be reduced or not reduced? It can be reduced. Sir, what you are saying? You said till now that you tie both these horses to opposite direction. Correct? Now, plus correlation, positive correlation, you should tie up the horse in the same direction. Yes, I will say, this is the cart, seen a cart. I have two horses here, H1, H2. Now I am putting both these horses in the same direction. Positive correlation, I told you direction is the reflection of this positive correlation. Now the point is, this is a weak horse. This is a strong horse. Agreed? Now you tell me, if both these together, this is pulling at 50 km/h, this is pulling at 40 km/h, you tell me children, whether the cart will move, okay, what will happen to risk you see? If only H2 is pulling, only strong horse is pulling, the cart will move by 50 km/h, assume, correct? The same speed of the horse, agreed? Now, theoretically speaking, okay, the weight will be there, even though it is pulling at 50 km, this will not move. Anyway, 50 km/h, it will move. Now the point is, okay, when there is another horse tied up on the same side, which is pulling at a lower speed, what will happen? The strong horse has to pull the cart, also has to pull the weak horse. Because of that, okay, the ultimate speed will get reduced. Diversification will still reduce the risk. What I am trying to say, you are understanding? It will still reduce the risk, which means even though there is positive correlation, the speed will not be same. It will still be reduced. The speed is related to risk, na? Okay, speed is like risk in my illustration. So the risk of the portfolio will still get reduced till 0.99, till the +1 perfect positive correlation, the risk reduction will happen. Are you all understanding? Now all this I have given as notes. That is why, to make you example, make you understand all this I have discussed. When a correlation between x and y is negative, it means when x increases, y decreases, and vice versa. Similarly, when correlation is positive, it means that when x increases, y also increases. This general movement, but the numbers -1 to +1, this captures the strength. -1 means every time it goes up, the other one goes down. This is +1, perfect +1. Every time it goes down, the other one, okay, also goes down. This is perfect positive correlation. I told you. Okay, correlation is strong if it tends toward +1 or -1. Okay, strong as it tends towards, or if it tends toward +1 or -1, and weak if it tends towards 0, which means you tell me children, 0.8 is the correlation. Is weak or strong? Strong correlation. Perfect or negative or positive, that is a different story. 0.8, now it's a strong correlation. 0.2, weak correlation. Are you all understanding? Okay, when correlation is +1, the points automatically fit into straight line sloping upward. This is not required. Chart, we show that all these things, this is not required, not relevant. Diversification, this is very, very important for understanding purpose. Diversification reduces risk because our return does not depend on performance on one security. When we construct portfolios having securities with negative correlation, the risk reduction is higher, and maximum risk reduction occurs when the correlation is perfect negative. When correlation is perfect positive, no risk reduction happens. When the last example I forgot to tell you, very simple, two horses, same speed, you put up on the same side. Okay, both are moving at the same speed. Yeah, the cart speed will reduce, will never reduce. It will be also moving at the same speed. Risk reduction will never happen. Risk reduction arises, no risk reduction arises due to diversification. Now, the important observation. In the previous, we have two extremes. When the correlation is +1 or -1, the formula will simply get simplified. Very simple. A square plus B square plus 2AB we learned. Apart from that, there was correlation. See, the A plus B the whole square formula, A square plus B square plus 2AB. Apart from that, there was correlation of A and B. Agreed? In our earlier formula, risk of the portfolio formula as per the Markowitz theory. Now what happens? When the correlation is +1 or -1, this will become +1. Are you understanding? When the correlation is +1, this will become A square plus B square plus 2AB only. Upper A square plus B square plus 2AB, square root of A square plus B square plus 2AB is nothing but A plus B square, which means A plus B. Simply A plus B. Are you understanding? A plus B means weight 1 sigma x plus weight 2 sigma y. This will become the portfolio risk formula. The formula, big formula was there, na? It can be simplified because R is +1, na? You substitute the +1 there, it will simply become A plus B the whole square. Simplify it, okay, you will get A plus B like this. Are you understanding? Okay, weight of x into sigma x plus weight y sigma y. Again, if correlation is perfect, negative, what will happen? This entire term will become minus. Up A square plus B square minus 2AB. Are you all understanding? Because of this minus 1, this will become minus 2AB, which is nothing but A minus B the whole square. It's an expansion of A minus B the whole square. Na? So simply square root of A minus B the whole square, A minus B, or W1 sigma x minus W2 sigma y. This is when correlation is -1, perfect negative correlation. Are you all understanding? When correlation is +1, portfolio risk formula will get simplified and become this. And similarly, when correlation is -1, W1 sigma x minus W2 sigma y. The portfolio formula, big formula, gets simplified. Are you all understanding the logic? Now, shall we move on? Okay. Now, I told you at some proportion, if you invest, due to this negative correlation, assume when the correlation is perfect negative, okay, the risk can even be reduced to 0. The risk can even be reduced to 0. I told you na. Now how it can be reduced to 0? In some proportion, you don't know what is the proportion, correct? There is a formula. If you invest your money in some proportion, assume you have 100 rupees. Okay, sometimes I may invest 70 rupees in security A, okay, 30 rupees in security B. Sometimes I invest 60, 40, 50, 50, anything is possible. But when the two securities correlation is perfect negative, -1, you can construct a portfolio using some proportion, which we will find out. There is formula for this, is called as minimum variance, zero variance portfolio. As per Markowitz theory, you can even reduce the risk, portfolio risk, to 0. You can bring, I told you na, -1, if the correlation is -1, you can reduce the portfolio to 0, but it cannot be reduced always. Means there is some proportion in which you have to put your money. It's not like you put 100% in one security and expect the risk to become 0. What proportion I need to invest in this security? What will be the weight? The W1, W2 there, na? This W1, W2, okay, you need to find out. For there is a formula. If you put W1 as 70%, W2 as 30%, whatever it is, your portfolio risk will become 0. Are you understanding? Very simple. Proportion of x, when correlation is -1, to bring the portfolio risk to 0, what you should do? What is the proportion? Simply sigma y by sigma x plus sigma y. Here, proportion of y is nothing but sigma x, numerator la sigma x divided by sigma x plus sigma y. Are you all understanding this? Very simple. What is the proportion of x? Sigma y divided by sigma x plus sigma y. Okay. What is the proportion of y you should invest? Sigma x in the numerator divided by sigma x by sigma. Sigma x plus sigma y in the denominator will remain same. Numerator, opposite securities numerator you will take. Okay, I will discuss what is the derivation of this. You will have absolute clarity. Even if you forgot in the examination, you can get back the thing. See, very simple. When correlation is -1, what happens? I just now discussed that. When correlation is -1, the portfolio become A minus B. Suppose sigma P is nothing but W1 sigma X minus W2. This is, okay, sigma Y. Correct? This is A minus B. Simplified it. Correct? Now, the proportion of Y, this is proportion P1 and this is assume P2. Proportion only I call it as weight 1, weight 2. I can call it as P1 and P2. Okay, this is nothing but proportion of Y. Because weight of Y, not proportion of Y. This is nothing but proportion of X. Are you all understanding what I am trying to say? Here, the proportion of X only I summarize as PX. Proportion of Y only I am called as PY. If this is the case, okay, how to find out? See, very simple. The PY, only two securities in the portfolio. which means if you invest 30% here, this is 1 minus 30, 70% na. Like this, Py is equal to nothing but 1 minus Px. This you agree? Two security portfolio. Okay, the cumulative value is 100% na. Okay, Py is nothing but 1 minus Px. This 1 minus Px, you substitute in this formula. Very simple. Okay, sigma P is equal to, okay, here I have given, straight away given. Okay, Px, sigma x, this is correct. This is the same. Minus, weight 2 was there na, Py. For Py you substitute 1 minus Px into sigma y. Okay, this you equate it to 0 because you need to bring the risk to 0. Up this left hand side portfolio will become 0. Up 0 is equal to, okay, Px sigma x minus, okay, this one you open it first, sigma y minus, okay, minus Px sigma y, correct? Now minus plus you open the bracket, what will happen? Px sigma x minus sigma y plus Px sigma y. Now if you notice, you bring this sigma y this side, okay, sigma y is equal to yes, Px also you can simplify. Px you can take LCM, Px, okay, sigma x plus sigma y. Are you all understanding? This you take it to this side, okay, sigma y divided by sigma x plus sigma y. This is nothing but, here I have given this formula. Can you see this? I'll just highlight it. Proportion of x, okay, see here, can you see this? This thing. Okay, proportion of x is nothing but sigma y divided by sigma x by sigma y. This is the derivation. Very simple. Just to substitute, equate it to 0, you will get the, so this is called as zero variance portfolio. This you will understand. Trust me children, this you will understand. Okay, very profound discussion. This only you will understand when you understand the 5 different, okay, possibilities in case of correlation, how perfect negative correlation can reduce the portfolio risk to 0. Everything is given. Are you listening? So this is how you compute correlation. Okay, so correlation, what is the now this is yes, this is how you compute the portfolio risk when the correlation is minus or plus 1. Now important question, all this you discuss, sir. What is correlation? What is the formula for correlation? Question arises na. Now I'll explain that. Please listen. See here. See, correlation, okay, see, is nothing but covariance of x and y. Correlation is nothing but covariance of x and y divided by sigma x into sigma y. This is the formula for correlation, finding correlation. I told you correlation is a standardized version of the covariance, which means, you see, we did now variance square root. If we square root the variance, we got the standard deviation. Are you all understanding? Same way here also, when we are trying to find out a standardized version of something, first you need that thing, correct? In the numerator you have to have covariance, which means which you are going to standardize, covariance na. So covariance you need to have in the numerator, covariance divided by, okay, product of the risk, which means sigma x into sigma y. This will give you the correlation. This will give you correlation. Now, so correlation formula you inserted covariance. What is this covariance? Question arises na. Yes, covariance. Okay, there are 2 possibilities. Without probability, how to compute covariance? Which means x post data, x ante data. Same way we categorize there na. When question is giving you probability based scenario based data, or when the question is giving you number of years past data is giving. Without probability, with probability, 2 different choices are there. Which means covariance you can compute under 2 scenarios, wherein without probability you can compute covariance, with probability. When question gives you probability, then also covariance you can compute in a different manner. See what happens, very simple. Covariance, how to compute? See, summation of x minus x bar. You tell me, the x minus x bar, we already have one column, x minus x bar, that will be same. Okay, x minus x bar column will be same. Y minus y bar also we computed, that is also same. In this, what we are doing now, covariance, for computing covariance, we will add one more column wherein we will multiply the x minus x bar as well as y minus y bar in one single column. Are you understanding? I'm going to solve and show you. Institute module ICAI practice panel question is there. Okay, while doing the question, everything will be clear. Okay, see, so summation of x minus x bar into y minus y bar divided by n you do when there is no probability given. Simple average. When there is probability given, what you do? X minus x bar into y minus y bar will be there. Okay, you have to add it, but after multiplying respective probability, which means probability into x minus x bar into y minus y bar, the total of it, summation, you will get the covariance. Are you all understanding? See, now we will try to solve here. Okay, when see here also, I'll come back to this portion later. Okay, first we will solve one question through which we can understand the formula or the concept in a better manner. See, historical rates of return of two securities over the past 10 years are given. Calculate the covariance as well as the correlation coefficient. Correlation is also called as correlation coefficient, same, of the two security, because coefficient of variation, it is something different which we will discuss later. Are you understanding? The risk can also be measured of covariance, coefficient of variation, that I will discuss later at the end of the chapter. See, correlation coefficient of these two securities we need to compute. So tell me children, which approach you will use? Without probability. Why? Because past data given, 10 years data given na. So very simple, observe what is happening. Just like security risk you computed, okay, you will have here, which means the return of security 1, R1, okay, R1 minus R bar, this R1 minus R bar the whole square, everything you already had individually discussed. While computing portfolio risk, see here, I'll show you, you had these column, correct? Where it is, yes, security X and Y, when probability is not given, you compute under this method. This is what I'm referring to. Here will be there, X minus X bar the whole square. For particular, first security X, you will compute, then for security Y you will, where it is, security Y you will compute like this, here Y minus Y bar the whole square, everything you will compute separately, correct? Now the point is, okay, when you are trying to compute this, okay, here what you do, you mix both these data. For computing covariance, na, what do you do? Okay, open all the column for security X as well as security Y, which means R1, R2 return of these securities is given. Okay, so here return of the security 1 dv minus R1 bar. R1 bar is nothing but total of these return divided by n. You will get 14.8, which means 12 minus 14.8 minus 2.8 minus 6.8, like this. Again you will square it up, R1 minus R1 R2 R1 minus R1 bar the whole square, correct? This you will square it up, the total summation also you will get. Are you all understanding? Same way, okay, this is for return to, here will be same, you don't need to, R2 deviation, R2 minus R2 bar, again R2 will be there, R2 bar you will find out 210, total of this divided by n, you will find the R2 bar, which means return of security Y bar. Here security 2, hence security 1 and 2 given. If it is X and Y, same X and Y, X minus X bar, no, Y minus Y bar, this is nothing but Y minus Y bar, this is Y minus Y bar the whole square, square it up, all these are same. Till now everything same, you just make it one column, risk of the portfolio, to find the risk of the portfolio. Now what is the change for finding covariance? Very simple, multiply this R1 minus R bar column and R2 minus R bar column, minus 2.8 into minus 1 plus 2.8 you will get. Are you all understanding? This is the column 3, 4, 5, 6. The column 3 and 6 you will multiply. This is the product of this deviation you will get, which means minus 2.8 into minus 1 you will get 2.8, minus 6.8 into plus 1 into, yes, positive 1, minus 6.8, minus 7.8 into 3 minus 23.8, like this. Okay, you will get the product. This will give you what it will give, very simple. Okay, this will give you the total, agree, total of these products, then you just add it up. Okay, you will get minus 8 as total. This total minus 8 will be there. Okay, what you should do? Divide by n. Divided by n, you will get the okay, this is nothing but summation of all this product. Okay, divided by n you do, you will get the yes, minus 0.8. This can also be minus as well as plus. Okay, here it need not be between minus 1 and plus 1. Covariance need not be between minus 1 and plus 1. This can also be, say, 2.73. Any number it can be over and above 1. Are you listening what I'm trying to say? But standardized version, when you are computing correlation, the correlation, okay, here while you computing correlation, it will always be minus 1 to plus 1. It will fall between these two. Are you all understanding? Say covariance. Now we got covariance. See, now you see the formula without probability I have given. How to find out? Summation of x minus x bar, y minus y bar, okay, when you get it total divided by n, are you understanding? When the probability is given, you multiply this every number, you multiply with respective probability, then find the summation. You will get the directly covariance. Are you understanding? Now we got the covariance as 0.8 minus 0.8 is the covariance. What is the formula for correlation? Covariance divided by sigma x sigma y. Are you understanding? So covariance, you found out the numerator, divided by sigma x sigma y. Sigma x sigma y we can simply find out with the existing data. With the existing data, how to find out? That's why they are computing standard deviation of security 1, which is nothing but n number of years given exposed data. So square root of, okay, x minus x bar the whole square divided by n. Already we computed 207.6 is there. So 207.6 divided by 10, which is 20.76, square root of 20.76, 4.56 is the standard deviation of x. Standard deviation of y similarly comes to 2.9. Okay, and correlation minus 0.8 divided by sigma x 4.56, sigma y 2.9. Okay, will give you the correlation minus 0.0605. Are you listening? Okay, this is how you will compute correlation coefficient. So risk of, so till now what we have revised, okay, first we revised individually respective years how to find out return for each year from the security. P1 minus P0 plus D dividend for respective year divided by P0. This is how you compute individual returns, correct? Next we compute risk and return of individual securities. Risk and return of individual securities. Okay, this can be found out under two scenarios: exposed data given, ex ante data given, which means probability given, probability not given, or probability given. Probability not given, now what you will do? Total return you will consider. Return of the individual security, how to find out? Very simple. What we will expect? Average return, mean return. How to compute when probability is not given? Simply add up the return divided by n. You will get the average return, mean return, when probability is not given. Agree? When probability is given, what you should do? Just multiply weighted average return. So use the probability as weight and multiply the return of the security and find out the weighted average return of the individual securities, weighted average return of the security. Are you understanding? Next, risk of the individual security. How to find out risk of the security? Very simple. Standard deviation, I told you na. Standard deviation, square root of, okay, summation of x minus x bar the whole square divided by n when probability is given. When probability is not given, how to do? Square root of, okay, p into summation of x minus x bar the whole square. Are you understanding? Individual securities risk and return we computed. Then portfolio's return risk we computed. Portfolio return, what is portfolio return? Weighted average return of the individual securities inside the portfolio. Very simple and straightforward. Portfolio risk, what we did? Portfolio risk we used a formula. Okay, big formula na, square root, okay, a plus b the whole square formula na, square root of, okay, w1 square sigma x square plus w2 square sigma y square plus 2 into w1 w2 sigma x sigma y into correlation of x and y. And then correlation we discussed. Correlation formula, what is the correlation formula? Covariance of x and y divided by sigma x into sigma y. Denominator sigma x into sigma y. Now, how to find out covariance? I told you, without probability, with probability. Without probability, we just solved one question also. Okay, this is the formula also. I have given summation of x minus x bar into y minus y bar, okay, divided by n. With this, we have completed the basics of this thing. Okay, we computed all these basic issues. Okay, few more discussions are pending. Okay, first we will do two questions regarding the portfolio risk and return. Okay, and simple questions only. Two questions we will do. Then we'll try to understand. This is for two security risk. This is only in case when there are two securities in the portfolio. Now we'll try to understand when the number of securities increase in your portfolio, how to compute for 3 security portfolio or n security portfolio, how to compute risk and return of the mainly risk of the portfolio, how the formula will get elaborated, what is the impact of it, we'll try to understand. Thereafter we'll start with Markowitz portfolio theory. So 2 questions we need to discuss now. Okay, take question number 3 for discussion. Okay, Mr. X is holding 2 securities X and Y in his portfolio. With the details given below, calculate the portfolio risk and return. Very simple and straightforward. Just now we computed na, security X and Y given, proportion given, 60% of the money is invested in security X and 40% is invested in security Y. Standard deviation is 10 and 16 and return 20 and 25%. And correlation of these 2 securities is 0.5. What is understanding? Plus 0.5 plus 0.5. Okay. See, portfolio return. Portfolio return X and Y proportion return weighted return. I told you na, simple weighted average WACC computation you do na, same way proportion return and weighted return. Okay, 0.6 into 20 plus 0.4 into 25, you'll get 22% as portfolio return. Portfolio risk is simple. The square root of W1 square sigma x square plus W2 square sigma y square plus 2 into W1 W2 sigma x sigma y, a correlation of x and y, 10.74%. Next, question number 4. Novex owns a portfolio of 2 securities with the following expected return, standard deviation and weights. Okay, all this is given. X, Y, this is return. Okay, expected return, which means already given expected return, a mean return. Are you understanding? So these are all expected return given, and the security x and y's risk is also given, sigma x and sigma y. 0.4 proportion given. What are the maximum and minimum portfolio standard deviations for varying level of correlation between 2 securities, which means maximum and minimum portfolio standard deviation. Okay, see, very simple. Maximum portfolio risk will be at that point when correlation is perfect positive, because there will be no risk reduction happening due to diversification, which means if you construct a portfolio using x and y and okay, the correlation is perfect positive, which means will it have any impact on the portfolio? Will it reduce the risk of the portfolio? Nothing it will do. Okay, it will not reduce the risk of the portfolio as such. So max portfolio risk na, when the correlation is +1, at that point the portfolio risk would be maximum. Portfolio risk is nothing but at that point, if I told you now, if the correlation is +1, what will be the formula? Simply A plus B, which is nothing but weight 1 sigma x plus weight 2 sigma y. That is what they have done. Weight 1 sigma x plus weight 2 sigma y. 0.4 into 15% and 0.6 into 20% gives you 18%. Are you all understanding? This is a maximum portfolio risk. Minimum portfolio risk, what is that? Minimum portfolio standard. This is not max, this is minimum. Minimum portfolio risk when R is equal to -1. R is equal to -1, what will be the formula? W1 sigma x minus W2 sigma y. That is what they have solved. Okay, 6% is the minimum portfolio risk. Are you all understanding? Now they are asking, this is the first part of the solution. What are the maximum and minimum portfolio standard deviation, varying level of correlation between 2 securities? Na? +1, extreme level they are asking, +1 as well as -1. That is that. Now, second part of the question, if correlation is -1, calculate the proportion of the individual securities in the portfolio to reduce risk to 0. Zero variance portfolio. I told you what is the formula. Okay, proportion of x is equal to nothing but sigma y divided by sigma x plus sigma y. Proportion of y is nothing but sigma x divided by sigma x plus sigma y. That is what they have done. See, proportion of x is nothing but, there is nothing but is to be understood as weight of x. This is nothing but weight of y. Okay, weight and proportion, everything one and the same. So proportion of x is nothing but sigma x by sigma x and y. 20 by 15 plus 20, 57%. 15 by 15, 35, 43%. Are you all understanding? Simple and straightforward application of the formula. But you will never understand why this formula came without having such long discussion. Are you understanding? That's why I have discussed all. Okay, next, understanding a 3-risk security, risk of a 3-risk security portfolio and n security portfolio. See, now we discussed the a plus b the whole square formula. Okay, a square plus b square plus 2ab, all this we discussed now. Weight 1 square sigma x square plus weight 2 square sigma y square plus 2 into w1 w2 sigma x sigma y, correlation of x and y. This big formula we use now. This for 2 security portfolio. 2 security portfolio. Now we will try to understand 3 security portfolio, or for that matter n security portfolio. Any number of security you take, how to understand the formula. See, very simple. We need to construct a matrix. I am showing you a matrix, okay, showing all the terms available. There are 2 types of terms, variance term, I call it as variance terms and covariance terms. Very simple. Okay, see, very simple. What happens, I'll tell you. See, here in case of 2 security, I'll explain you the matrix later. First, in case of 2 security, we already learned now. There is a square plus b square. To simplify, I'm using this formula. Okay, a square plus b square plus 2ab. Agreed? This a square, now the square terms is called as variance terms. Variance term. Okay, this is variance term, which means here, if you notice, there are 2 variance terms, a square, b square. 2 variance term, squaring it up. Now, there's one more thing. 2ab is there. Either 2ab, what is this? You see, this is nothing but ab plus ab. Are you all understanding? The 2ab is nothing but ab plus ab is 2ab. Now, ab is what? Is covariance term. I call it as covariance term. Just now I discussed na, ab, which means the product, a into b, na, this is a product. Are you all understanding? Product term, which I call it as covariance terms. All the logic I discussed in the explanation of covariance. Are you all understanding? Okay, so the AB plus AB became 2AB. Now, there are 2 covariance terms, which means, okay, for a 2 security portfolio, how can I conclude this? For a 2 security portfolio, 2 portfolio, okay, how many variance terms? Two variance terms, total terms. What is the total term? See, very simple. Two security portfolio. What is the total term? Four terms are there. Very simple. Two variance term, okay, and covariance term. How many covariance term? Two covariance terms. Total comes to 2. Are you listening what I am trying to say? Which means, to put it simply, for a 3 security portfolio, can you guess what will be the situation? Okay, very simple. Total, how many terms will be there? N square term. For any security you take, any number of security you take, 10 security portfolio, 10 security portfolio, 100 security portfolio, any number you take, okay, the number of securities inside the portfolio, if you square it up, that will be the total term, which means 3 security portfolio will have 9 terms, okay. Now, what will be, how many variance terms will be there in that? N number of variance terms, which means 2 security portfolio, the variance terms will be 2. 3 securities portfolio, the variance will be 3 terms. 3 variance terms will be there. How many covariance there terms? N square minus, okay, this 3, whatever it is, okay, 9 total term minus 3 is equal to 6. Are you all understanding? Okay, to put it simply, this you can also say n into n minus 1. Okay, so n into n minus 1, not total term 9. Okay, this is n total terms 3 into 3 minus 1, 2 is equal to 6. This covariance terms, okay, to put it simply, for n number of securities inside the portfolio, the variant total terms will be n square terms, and out of n square terms, okay, the variance term will be n number of terms will be variance term, n into n minus 1 terms will be covariance terms. Are you all understanding? To put it simply, now I can show you that the formula for a 3 security portfolio. You will understand. There is one institute question also. Later on we will solve. I have put it in sharp single index model. Okay, there is one question which is asking to differentiate between, okay, calculate the risk as per sharp model, as per Markowitz model. This is as per Markowitz model. Markowitz model, okay, the mean variance analysis uses mean variance analysis to find out the risk, right? So here what happens, you see, 3 security portfolio, see, this is A square, this is B square, and this is C square. These 3 terms are various terms, 3 various terms are there, variance terms are there. Are you all understanding? Upper square root of W1 square, sigma x square plus W2 square, sigma y square plus W3 square, sigma x square, sigma z square. This you do, plus apart from that, okay, 6 covariance terms now. So 6 covariance terms in this 2 product terms, which means 2 into W1, W2, sigma x, sigma y, correlation of x and y. Again 2 into W1, W3, weight of 1 and 3. Again sigma x and sigma z, and correlation of x and z. Are you all understanding? Next 2 into W3 into 2 into W2 into W3 into sigma y into sigma z into correlation of y and z. Are you all understanding? This is nothing but something similar to a plus b plus c the whole square. Are you all listening? So now here what's happening? Matrix showing the variance of 3 securities portfolio. Here matrix you can understand. Here I have W1 sigma x, W2 sigma y, W3 sigma z. Like this, okay, in the horizontal I put it like this. In vertical also W1 sigma x, W2 sigma y, W3 sigma z. Don't think it is irrelevant. In the institute material itself they have given this matrix. Are you listening? One of the questions they have shown in the matrix and calculate the total risk. Understood? So the total risk is nothing but total variance terms plus the covariance terms. Now here see what happens. Variance term, W1 square sigma x square, 1 variance term, this is 1. W2 square sigma y square, this is 2. W3 square sigma z square, this is 3. This is 1, 2 and 3. These 3 got substituted in this formula. Are you understanding? Now 2 into W1, W2, sigma x, sigma y, correlation of x and y is there na? You observe carefully. What is there? Okay, W1 and W2. So take this W1 and take here W2 and see the common thing. W1, see I can mark it like this, yellow. Okay, I use this sketch. Can you see this? W1, W2, sigma x, sigma y, correlation of x and y, relationship between x and y. The same thing if you can see, here also it is there, okay, because here also in the matrix W2y, here W1x. If you see this, here W1, W2, sigma x, sigma y, correlation of x and y. Now these 2 terms if you simply add, it will become 2 into this term, 2 into W1, W2, sigma x, sigma y, correlation of Okay, X and Y. Are you understanding like this? Okay, other thing, if you see here W1, W3, here W3 and W1, if you consider this, you will find, okay, one covariance term. Again, same here also, there are two covariance terms. This plus this will give you 2 into W1, W3, sigma X, sigma Z into correlation of X and Z. Okay, same way, plus 2 into W2, W3, sigma Y, sigma Z. This is nothing but these two covariance terms, which means 6 covariance terms, 3 variance terms. If you simply add up, you will get the total risk. Are you understanding? We can observe that there are 9 terms for a 3 security portfolio. It has 3 variance terms and 6 covariance terms. Similarly, for an n security portfolio, we will have n square terms, n variance terms and n into n minus 1 covariance terms. Are you understanding? For example, for a 100 security portfolio, we will have 100 square, 10,000 variance terms and 10,000 total terms and 100 variance terms and 9,900 covariance terms, just to make you understand the facts. Okay, now we will move on to Markowitz portfolio theory. Yes, Markowitz portfolio theory we will discuss in the next video. Thank you.